So we're going to Accounting AS, Chapter 5, Capital Expenditure and Revenue Expenditure. So when we talk about capital expenditure, it's about spending on non-current assets. And when we talk about non-current assets, these are assets that could last for more than years. That's why we call it non-current assets. So yeah, capital expenditure, this implies to the spending on non-current assets. We talked about that. These spendings might include the following one. We have delivery cost.
Okay.
Delivery cost of an asset. And when we talk about delivery cost of an asset, we're talking about
Spending non-current assets.
spending on non-current assets or
So-
fixed assets
So assets that were one take.
that can last more than a year. Yeah.
Okay.
So one way, the first expenditure here is delivery cost. The amount you spend to bring the asset into the premises. Oh, you bought an equipment. The cost of bringing that equipment to the premises, it's part of your capital expenditure.
Yes.
Installation cost, to install it, to make it work, is still part of the initial cost.
Okay.
Then legal cost, which is incurred in obtaining the asset. So whatever formality you do in that you have to pay for to acquire that asset, it's part of the cost because you won't pay for it again after now.
Okay.
Then we have the cost of improving the assets, but not repairs. When we talk about the cost of improving the asset, that means you want to improve the value of that asset.
Yes.
But it's not like you are not repairing it or maintaining it. Whatever you do to make that asset, improve,
Okay.
it is part of capital expenditure because it won't come every day.
Perfect.
Is it clear?
Yes.
Notes: these costs are added to the initial purchase cost of the asset. So the amount you purchase the product with the delivery cost, installation, legal, and whatever cost you spend, that's just going to be for that particular point in time when you purchase that asset.
Perfect.
Are all capital expenditure.
Perfect.
Is it clear?
Yeah.
So it is recorded in the statement of financial position. So for your capital expenditure, it is part of your statement of financial position where you record your assets.
Financial position.
Statement of financial position.
Okay.
Now you have your statement of profit or loss and other comprehensive income. That's where you record your revenue expenditure. But for capital expenditure, it goes into your statement of financial position. Is it clear?
Yes.
And it does not affect the statement of loss or other comprehensive income. So whatever you spend there doesn't affect your profits. Is it clear? Is it clear, please?
Yeah.
So go to revenue expenditure. For revenue expenditure, I wrote this implies to the day-to-day spending in the business. Examples of revenue expenditures are office expenses, your office, rent that you have to pay, rates, eating and lighting. All these overhead costs are part of your revenue
Insurance,
expenditures.
fuel cost.
They are all part of revenue expenditure. Is it clear?
Yeah.
Also, costs associated with the use of non-current assets will be considered as revenue expenditure as they do not improve the assets. So if you spend on non-current assets, but not to improve it, but to repair or to maintain it,
Exactly.
it is part of revenue expenditure.
Okay, so if you maintain delivery cost, make it better, make it more faster.
Maintenance.
Yes.
No, more faster is improvement.
Improvement. That's still
Maintenance means you service.
Okay, installation cost.
No, it is capital.
It's capital expenditure, installation cost. But we maintain installation cost, so every week we install something.
No, if you are installing a new software,
Yeah.
it is capital expenditure.
Whatever
whatever
if
you
we make
do,
the software better.
That means you're improving the
Yeah,
assets.
so that's revenue.
It is not revenue. When you are maintaining that asset, that is revenue expenditure. Like you have a car,
Yeah.
you service it every month.
Yeah.
So that is revenue expenditure. But if you're purchasing a new driver's license or a new plate number,
Oh, yeah.
or you are expanding the car, or you are putting a new seat,
Yeah.
these are capital expenditure.
Perfect.
Is it clear now? Good.
So a capital expenditure is spending on non-current assets.
Or improving a non-current asset.
And revenue, it is day-to-day spending.
Yes, for maintenance or repair.
Maintenance.
Is it clear? Any question about that?
No.
So we go to classifying. Classifying capital expenditure and revenue. No, the difference between them. Sorry.
Yeah, exactly.
Sorry. I will explain it now. Sorry, I skipped that before. So,
You want to write it down, sir?
no, I wrote it. So I'm just gonna. I made 3 points. So let me just.
Okay.
Okay. So the difference between them are what we just talked about. One, the benefit of assets is derived for more than 1 year. So for capital expenditure, the benefit of it, the benefit you get from purchasing that equipment or machinery or technology, the benefit is for more than a year.
Because it's not current assets.
Yeah, but for for revenue expenditure, the benefits last within a year.
So what is current assets?
Current assets, like your stock, cash.
Yeah, I said it's current assets.
There, it includes initial cost and upgrade to non-current assets. So, like I told you, whatever you do to upgrade, to improve that asset, it's part of capital expenditure. But if you have to repair,
okay,
it is a non-current. It is a current.
So if you want to upgrade something new, a capital. If you want to
whatever you do that improves it.
Yes, and maintain it. Okay.
Maintenance is revenue expenditure. It includes, is it clear?
Yeah.
So spending is to increase the value.
Yeah.
So whatever you spend, whenever you spend on that capital, on that equipment, that increases the value of that equipment is part of capital expenditure. You know, sometimes you have an equipment, then you spend on it, then it looks more better.
Yeah.
And you can easily sell it at a higher price.
That's capital expenditure.
Yes. Is it clear? But it includes spending to maintain the value of one. So if you just have to maintain the value of that equipment or machinery, it is a revenue expenditure. Is it clear? Is it clear, please?
Yeah.
So we go to classification, classifying, which is classification. For classification, why do we have to classify capital expenditure and revenue expenditure? Because in the course of us preparing our financial statements, it is important for us to distinguish between capital expenditure and revenue expenditure. Capital expenditure should go into your statement of financial position, and revenue expenditure should be in your statement of profit or loss. Because if you don't do that, because if you don't understand, classifying capital expenditure and revenue expenditure. So what I'm saying is, as a business, you have to prepare your financial statement, right? The financial statement comprises the statement of profit or loss and other comprehensive income and the statement of financial position. So for your capital expenditure, it has to be posted in your statement of financial position, and your revenue expenditure, it has to be part of your statement of profit or loss, statement of profit and loss and other comprehensive
so capital
income.
expenditure, it is in statement of financial position.
That is the classification.
Revenue statement of profit or loss.
For revenue expenditure.
Yeah.
Because if you don't do that, you won't be, if you don't record them correctly, the value of your assets and profit will be wrong.
Yeah.
So the main purpose of classifying the capital expenditure and revenue expenditure is to have an accurate value of assets and profits.
Like accrual years.
What?
Never mind. Accrual concept.
Accrual.
Yeah.
Yes, accrual concept. Yes. Thank you. So we'll go to the activity now. I did activity 1. You're going to do 2 yourself.
Okay, let me do it. Okay. Thank you.
No, let me finish 1 here.
Oh.
This is case study 1. Activity 1. Classifying the capital expenditure and revenue expenditure. Classify each of the following as either capital expenditure or revenue expenditure. The first one, installation cost of new machinery. That is capital expenditure. Installation of a new machinery is a capital expenditure. Carriage inwards on goods for resale. On goods for resale, that's revenue expenditure. Carriage inwards on delivery of new machinery. Capital expenditure. Wages to warehouse staff.
Capital.
Revenue. Wages.
Wages. Yeah.
Wages to warehouse staff. It's revenue expenditure. Power cost of operating the machine. It's revenue
because we're operating it
every now and then. Then legal costs on the purchase of an
capital.
office building. It's a capital expenditure. So you have activity 2 to get done.
Okay.
So we'll go to impacts of errors in classification of expenditure. So if expenditure is wrongly classified in the accounts, it will have an effect on both statement of profit or loss and other comprehensive income and the statement of financial position. So if we wrongly classify expenditures, either capital expenditure or revenue expenditure, that means it's going to affect both the statement of financial position and the statement of profit or loss.
Materiality.
Materiality.
We cannot make no mistakes. We have to be
Yeah. Items must go in line with where items must go to where they are supposed to go to. So, if any expenditure is wrongly posted, if it was supposed to be capital expenditure, you record it in revenue expenditure, it will affect the statement of profit or loss, and it's going to affect the statement of financial position. So, for capital expenditure, if capital expenditure is treated as revenue, profit will be understated, as expenses will be wrongly increased. Listen, for capital expenditure, which is expenses on spending on long-term assets, right, or non-current assets. If you mistakenly record it, or you treat it as a revenue, capital or a revenue expenditure, it will reduce your profit. Your profit will be understated. Why? Because capital expenditure is always large. It's high amount of money, you know. So you have recorded, you mistakenly recorded it in your statement of profit or loss. That would increase your revenue. It will increase your expenses.
Expensive. So what will increase your loss?
That means no, it's not going to increase your loss. It will reduce your profit.
Profits, yeah, reduce your profit.
Get the point here. If capital expenditure like the purchase of motor vehicle is being recorded as revenue expenditure, like maybe motor vehicle expenses, so it means your expenditure will be higher, and that would reduce your profit. Is it clear? So that means it's going to affect your statement of profit or loss. Your profit will be understated. Is it clear? If revenue expenditure is classified as capital expenditure, then profit will be understated, as expenses will be lower, while the statement of financial position will be overstated, because the value of non-current assets will be what? Increased wrongly or incorrectly. So what we are saying is this: if revenue expenditure, which is supposed to be in your statement of profit or loss, is being recorded as a capital expenditure, your profit will be overstated. You have more profit because it is your revenue expenditure is not part of your items anymore. You have motor vehicle expenses or motor vehicle maintenance, which is supposed to be recorded in your expenses, in your statement of profit or loss, but you mistakenly recorded it in your statement of financial position as an asset. It means that your revenue, your expenditure would reduce, and if your expenditure reduces, it means your profit will be overstated. Okay. But what happens to your assets? Your assets will also be what? No. Will increase, will be overstated. Both profit and assets will be overstated. That is the consequence of recording revenue expenditure in capital expenditure. Okay. It increases your asset and at the same time increases your profit. Okay. And both of them are incorrect. Okay. Is it clear? Is it clear, please? Yeah. So that takes us to
question 3.
Activity 3. For activity 3, we have different items. So here this is our first made in computer sales, computer hardware and software. During the year, it has invested in a new inventory control system. The following transactions have been recorded as capital expenditure and revenue expenditure. We have items such as new computer for resale, new inventory control system, installation cost of new system, staff training for new system, maintenance of inventory control system, computer supplies for new system. So here we have the figures. For 160, 160, 40, 2,000, and capital expenditure we have 10,000, 7,000, 450, 500. So we have to, the items are not correct, so we have to put them in the correct position, either as in the statement of profit or loss or the statement of financial position. So I'm going to start with the first one. They said new computers for resale. New computer for resale is purchase. It's purchase.
So it is a revenue expenditure.
It's revenue expenditure. Yes.
So it's correct.
It's correct. The new inventory control system. New inventory control system is a purchase. It's a new system.
Yeah, so
it is capital expenditure, okay, which is going to go to your statement of financial position.
So you're going to make another ledger and put
another table, not ledger, table.
And put the 40,000.
So the item, you're going to have your items, then you have capital expenditure, revenue expenditure. Under your capital expenditure, you're going to have your statement of financial position. And under your revenue expenditure, you're going to have your statement of profit or loss and other comprehensive income. Right. So our purchase here is a purchase of new inventory system and new computers for resale. So for the resale, it's going to be revenue expenditure, which is correctly done. But for the new inventory system, which is capital expenditure, which is 40,000. Installation.
Capital.
It's capital expenditure. Then training cost. It's not going to be for every time, so it's revenue expenditure. Maintenance cost is going to be revenue expenditure. Then computer supplies is also revenue and computer supplies. Revenue expenditure. So the total capital expenditure here is 50,000. That's 40,000, which is purchase of new inventory and installation. And the rest goes to your statement of profit or loss and other comprehensive income. Then we go to capital income and revenue income. Are you there? Yeah. For capital income, this for revenue income I wrote is a result of the benefits or the receipt of operating activities in the business. So all items that involves the day-to-day running of the business, which you receive, is called revenue income. Examples are revenue from sales of inventory. Your stock, when you sell them, it's a revenue income. Rent received, maybe you give part of your office to a tenant.
Yeah.
You receive income from that. It's part of revenue income. Commission received. For maybe you sold an asset. You receive a commission from selling a property.
Yeah.
It's a revenue. It's a revenue income. Interest received. You gave a loan out, or you gave, maybe you saved money, you receive interest from it, or your credit customers, they paid late, then you charge them interest. These are revenue income.
Okay.
Then discount allowed. Why is this? Is discount allowed? You gave discount to your to your customers, but why is it part of revenue income? It's part of revenue income because you have given discount based on the fact that sales is coming in.
Okay.
Do you understand?
Yes.
It's going to be on the debit side too. Here.
Okay.
Then we have capital income. For capital income, we're talking about receipts of money which is generated through non-current assets.
Okay.
Like
money generated to non-current assets.
Yes, like your
So
capital, the amount of money the owner of the business introduced into the business, or you take a loan from the bank.
Perfect.
So these are what we call capital income. Any question about that? So that ends the chapter. So
Let
we
me
go
to
to
the exam
the exam practice.